In our last chapter, chapter 12, we're going to look at segment reporting, which relates somewhat to the consolidation concept, because once FASB ruled that all components of a consolidated group are reported as a single economic entity, some of the detail was lost, and some people argue that the financial statements were harder to interpret because different segments or different parts of your organization may have very different metrics and measures. So therefore, segment reporting is designed to help with that. Well, what is a segment? A segment is something that is significant and passes one of three tests. And the three tests are shown down here in the second box. You have to have 10% or more of revenue, profit, or assets. And how those segments are defined talks about in your text, but it really boils down to a lot of how management sees their business. And if you look at a number of examples, they generally follow along with product line or industry or location. Those are some of the common types of segments that you see. So we're going to do exercise 11 as an example of what happens with segment reporting, and hopefully this part, now that we're towards the end of the semester here, is a little bit of a break, and it's much less intense than the material we covered earlier. So far I've put into the template the items that were just given in the book. The identified segments, which management identifies, their external revenues, intersegment or internal, those intercompany transactions that we dealt with in consolidations, and then all I did was sum the assets that were given. So what we have left to fill in is the reported profit or loss, and this requires just a minimum calculation here. So we take the total less the expenses that are given in the book to get each segment's profit or loss. Now you'll see that the talent agency actually has a loss, and when we're dealing with losses, we end up treating those in some of our calculations at absolute amounts, and we'll look at that here in a second. The radio stations also had a loss, and our total reported revenue and losses then, our total revenue and losses combined is $3,843,800. But because we have both profits and losses in there, we need to segregate it out. So let's add up the amounts that are income, and our total of all reported profits is $4,530,800, and the total of our reported losses is $687,000, and that's going to help us with our calculations in the next part because we've got to segregate that out. So then the actual identification of the segments comes back to these three tests. So in this case we want 10% or more of total revenue. For the profit or loss we want 10% or more of the absolute of profit. We're going to use the total of all the reported profits for that one. And then for the total of the assets, it's the $7 million. And you can do the 10%, hopefully it's pretty easy to see that we're going to pick up anything with revenues over $856,000. So if we look at our revenue column here, we see that talent agency and radio are the only ones that don't qualify. The other three do qualify. Now theoretically, here in the problem we're going to go ahead and do all of the tests. But once these three have been identified, you really don't need to do the other tests because it only takes one of the tests to make it a reportable segment. Now if we look at the absolute value of profits, we want anything that's more than 453 out of this column. So if this loss was greater than 453 as a loss, that would qualify, but it's not. So again, that one's kicked out. That radio stations and film, none of those meet the 10% here. So those are all no, and the other two are yes. And what you generally see is your reportable segments have yeses all the way across the board or 2 out of 3. The ones that have 1 aren't as frequent. Our last test then is if the assets are more than $702,000. So if we look at our items here, the only one that's not is the talent agency. So we can see the talent agency doesn't qualify at all. Publishing qualified in all areas, as did cable. The only one we ended up picking up at the end here is the radio stations. So all of the segments are reportable except for the talent agency. So that would be the separate identified items that we would report in the footnotes. Now you also have to do a test for significance. If you look back in our book, the total consolidated revenues given are $9,074,000. We have to report at least 75% of that. So we have to report in our segment reporting at least $6,805,000. If we look at the external revenue of the segments we are going to report, well, that's going to be the total less the talent agency, because that's the only one we're not reporting on, and we meet this test because we exceed that amount. So that part's okay. And then our last part is to reconcile the revenues and profits or losses to what's reported as consolidated. So the total revenue for our reportable segments is going to be, again, the total less talent agency, because that's the only one that's not included. The revenue for the non-reportable is the talent agency. We eliminate the inter-segment revenues because that, remember, would be eliminated in a consolidation. And then we need our corporate level revenues, which are going to be the total of the $9 million given less these segments. Anything that's not part of these segments was corporate or, small operations. It gives us the $1,351,000 there. And the sum then comes back to the $9,074,000, which is what our consolidated total is. So that reconciles the revenues. Now we do the same thing for profit or loss. So the total profit or loss for all reportable segments, again, we're going to take that and we're going to add back talent agency since that one was not reportable. And then the profit or loss for the non-reportable is the talent agency again. And at the corporate level, our revenues, we just calculated up above, and our expenses are the corporate level less the ones that we've reported before. So our total consolidated income should be $4,439,500, and that would reconcile back to the consolidated reports so that the footnotes agree with the reports. And that's what we do with segment reporting.